In Chapter 7, we look at receivables. So our first example is looking at a company that takes credit cards. So this means that the company takes credit cards from outside companies like Visa, MasterCard, American Express, etc. So when we take credit cards from Visa or MasterCard or any of the other various companies, they give us cash and we accept a fee. So basically, that fee is that they are taking on the risk of the customer not paying their bill, and they're giving us cash in exchange for that amount. So we have a customer that paid on April 8th. We sold merchandise for $8,400 that had a cost of $6,000, and we accepted the customer's credit card with a 4% fee. So we received cash from the credit card company in exchange for a 4% fee that we give them. So we would record a normal sales transaction where we receive cash and have sales revenue. We also have a credit card expense from that fee. So we would receive sales revenue of $8,400. We have a credit card expense that is 4% of that $8,400. And then we receive cash that is $80,400 minus the credit card fee expense. Remember, anytime we record a sale, we also have the cost of goods sold and the inventory. So we have cost of goods sold of 6,000 and inventory of 6,000. On April 12th, we also have a credit card sale, but that credit card has a 2.5% fee. So our counts all stay the same for the journal entry. The amounts change. So our sales revenue is $5,600. Our credit card expense is 2.5%. And the cash that we receive is the difference between the sale and our credit card expense. Our cost of goods sold is $3,500. And that is if customers are paying with a credit card that comes from Visa, MasterCard, American Express, or a bank card. If we provide the credit card, so we have a store card, then we just record that as an accounts receivable. That customer is going to pay us money. So then on April 30th, we would have an account receivable and sales revenue. So for $1,000, then we would have our cost of goods sold, $650 versus inventory of $650. And then on May 31st, we would have an adjusting entry for the amount of interest. So we would add that to the customer's account receivable, $4 of interest, and we would record interest revenue of $4. The next example that we're going to look at is what happens when customers don't pay their bills and we decide to write off their accounts as uncollectible. When we do that, we record them to the allowance for doubtful accounts and we remove their accounts receivable amounts from the books. So we would have a debit to allowance for doubtful accounts and we would credit the accounts receivable of each customer. So we would have a debit into accounts receivable of $6,800, and then we would credit each accounts receivable for their amount that they owe us. We need to keep a separate accounts receivable for each customer in an accounts receivable subsidiary account. Okay. Then on June 5th, we unexpectedly received $900 in cash from a customer that we wrote off on February 1st. So we then need to reverse that write-off. So we would restore that account receivable for Oakley Company by debiting them $900, and we would credit our allowance for doubtful accounts to reverse that transaction. We would then record the cash payment for that account receivable. The next item that we're going to look at is a percent of sales estimate. So we have two different ways that we can estimate our uncollectibles to follow our matching principle. We have percent of sales and then accounts receivables method. The accounts receivable method has two different methods. So all told, there's three methods, but your book says two methods for one is percent of sales and then the other being accounts receivable method. With that estimate, we need to prepare an adjusting entry at the end of each period that records our bad debt expense against the sales in that period. So our first entry is here at year end on December 31st. We need to record our adjusting entry for bad debts expense. So we are going to debit bad debt expense, and we are going to credit allowance for doubtful accounts. The amount of that is 1% of our annual cash sales, $487,500. So 1% of that amount, which is $4,875. Then it tells us on February 1st, we've decided that the account of P Park is uncollectible and we write it off as a bad debt. So February 1st, we are going to record that to the allowance for doubtful accounts. For $580, and we're going to remove their account receivable. $580. Then on June 5th, we unexpectedly received the amount from Park. So we need to reverse that transaction. And then we can record the cash payment for that amount. Now we're going to look at the percent of accounts receivable. So with the percent of accounts receivable, instead of using sales, we take the percentage that we estimate uncollectible of our accounts receivable. So it tells us our accounts receivable is $55,000, and then we estimate 2,000 of that will be uncollectible. So we'll take 55,000 times 2%, which is $1,100. Okay. Then we need to prepare our year-end adjusting entry to record bad debts expense under the assumption that the allowance for doubtful accounts has a $415 credit balance before the adjustment. So if you remember, in the percent of sales, our bad debt expense is that percent of sales that we deem uncollectible. However, in the two accounts receivables method, the adjustment is whatever it takes to make our ending balance. That amount. So imagine we had a T account for allowance for doubtful accounts. We're going to create that T account. Nate tells us that we have a credit balance of $415. So when we're looking at this, when we make this adjusting entry, we want our ending balance be $1,100. So we need to record a credit and to allowance for doubtful accounts and bad debt expense that makes this amount $1,100. So the final balance. So instead of just recording bad debt expense of $1,100, that's the ending balance we want for our allowance for doubtful accounts. So that's the main difference between percent of sales and the two accounts receivable method. So the debit balance that does that is $685. So if we credit then our account for $685, they will add together to become $1,100. The second part of this says, what if instead we had a $290 debit balance? Well, the journal entry is the same, it's just the amounts that change. So now let's bring our T account down here and put a $291 debit balance. Now we need to record a credit that makes this balance $1,100. So in order to do that, we need a bad debts expense of $1,391. So if we put a credit here then for $1,391 against our $291 debit, we would have an ending credit balance of $1,100.